it's important to acknowledge the almost impossible job that market makers actually have. What distinguishes market makers from anyone who's just trading via limit orders is that market makers, by definition, are forced to take both sides of the market. They don't just offer bidding prices on the thing that the market might want to sell to them, but that they need to post asking prices as well if people want to buy that asset from them. And that's an extremely difficult thing to do, especially with something as volatile as cryptocurrency. I previously argued that some of the stuff that we consider to be unethical, some of the practices that we see, have actually come about as a result of the volatility in cryptocurrency, where the inventory risk can be so extreme that you do need to keep a very healthy cash balance for those minus 76% days. And it is an extremely challenging position when you must buy things when people want to sell them to you, and you must sell them when people want to buy them. It's an aspect to that business that I think few people recognize is not just difficult, but stressful and almost impossible an ask.
Yeah, it's a thankless job because when you're doing everything right, nobody notices. But as soon as you screw up along the way, then you're hitting the headlines. But yeah, as you say, you're basically making, as a market maker, opposed to a private trader, a private investor, a day trader trying to deploy a ping pong strategy of trading between the spread. As you say, they don't have that obligation of necessarily taking both sides of the trade and maintaining some liquidity on the order book at all times, which makes it much more difficult for a market maker. And it forces us to also invest much more in the development of our tech stack. So again, like even on the institutional side that we're seeing now that's come online with us in the past 6 months, there the name of the game is eking out 1 or 2 basis points of profit per trade, which for a day trader or a crypto native degen, that's nothing when, as you say, you have single day candles that range 70+% in terms of volatility of oscillation, or that's where you can make actual alpha, where you can out trade the market. That's where I think a lot of people also get confused about the role of market makers, especially clients on the token side. They come with requests about actively trading for alpha, actively eking out profit. That's not the point of a market maker. Yes, you will be making money along the way, but it's not going to be measured in the X's of gains. It's going to be measured in basis points. And that's the point. Big volumes on a big trading pair with lots of organic trading activity, lots of traders active on the pair, and you're there making the spread and actually capturing the spread as your profit. That's how market making should be done. But then people add in alpha, they add in taking positions instead of staying market neutral, delta neutral. They take positions in the token because, as Mark mentioned, of how the industry is designed at the moment, where you have massive volatility, massive inventory risk, and you don't really have regulation to offset that risk.